What I've learned is I need to invest in stable companies, companies that I actively like, products that I use and buy all the time daily. Office products, tech, accessories, laptops, monitors, cameras, computers, things we utilize or do every day in our lives and businesses. Communication services, automotive, EV, travel, entertainment platforms, household products, necessities. The stock market is made up of sectors: energy, materials, industrials, utilities, healthcare, financials, consumer discretionary, consumer staple information, technology, the FANG, communication services, and real estate. You need to pick what you like in a stable sector. I follow the money to grow my money. A high growth company would be a company with a large market cap, a blue chip company, or a corporation with a national reputation for quality, reliability, and the ability to operate profitability in good and bad times. A leading company in the sector, most popular would be the FANG stocks, which have doubled in the last 5 years. The FANG stands for four stocks: Facebook, Apple, Netflix, and Google. Also, another high growth stock would be Microsoft. Microsoft is the most valuable publicly traded company in the United States, with a market cap of $2,240,000,000,000. Apple's market cap is $2,550,000,000,000. Amazon's market cap is $1,780,000,000,000. Google's market cap is $1,920,000,000,000. Facebook's market cap is $1,070,000,000,000. Walmart's market cap is $412,000,000,000. Johnson and Johnson's market cap is $452,000,000,000. JP Morgan Chase market cap is $474,000,000,000. Visa's market cap is $488,000,000,000. Procter and Gamble market cap $350,000,000,000. So you see, those are all blue chips because they got the money. So I also personally like Disney, market cap $336,000,000,000. Coca-Cola $243,000,000,000, and Nike $225,000,000,000. High-risk stocks are equity investments where an investor can experience significant losses, if not lose all their money. Generally, high-risk stocks tend to be from cyclical, volatile industries or be newer, unsettled companies. Volatile stocks can be a lucrative investment if you're willing to hold through a bumpy ride. Beta represents the slope of the line. The higher its beta, the more volatile a stock is likely to be. The prices in the market move. The greater the disparity between the demand and supply, the more significant the move will be. So, high-risk stocks could be worth the volatility. When a stock is heavily shorted, an investor are buying shares, which pushes the price up. Short sellers start buying to cover their positions and minimize losses as the price keeps rising. This can create a short squeeze. Sellers keep having to buy the stock,
What are you saying, Papa?
pushing the price up even higher and higher.
That's what you're saying?
A short squeeze. Yeah, Z, that's what I'm saying. Where was I at? A short squeeze occurs when short sellers shorted the stock. In order to close out their short position, their sellers are forced to buy to cover, creating heavy demand. Forced to cover or margin call, prices rise. Remember, price only rises to the point buyers find attractive. When the majority of traders are buying, majority thinks price will increase, thus buying pressure. When the price is less attractive, majority of traders are selling. The majority thinks stock price will decrease, thus selling pressure. Most shorted stocks, according to my research, Google search, and the news, high-risk businesses are anything in a fast-growing industry. New, unsettled industries are particularly tough. So are the industries where it's easy for a competitor to enter the market. Also, industries that are considered attractive because they are big, growing, sexy, etc., are particularly dangerous. That's what I did, though. When I started investing in industries, simply because they were easy to buy, stock prices were low, pennies, affordable for someone broke like me, unlike someone who is wealthy, definition, having a great deal of money, resources, or assets, rich. You know, like that lives in, say, Atherton with a median home price of $6.3 million dated in 2020, or Pacific Heights in San Francisco, a median home price over $5.6 million in January 31, 2021. That's like now. Me, a person who lives in the inner city, the usual older, poor, and more densely populated central section of the city. Poor, lacking sufficient money to live at a standard considered comfortable or normal in society. I don't invest in stock prices anymore. The price of a company's stock is changing all the time, every day, every minute. I follow the money. I invest in companies with the bag. You know what I'm saying? Capital, large market caps. I trade high risk stocks, penny stocks, when I see an opportunity, potential of the stock for large swings in value that may occur. I also get in and out quickly as possible for positive gain return. Unless I like the company, like Disney, Nike, Coca-Cola. I drink it every day, right? Um, so I trade. I trade the riskier stocks though for profit to gain, um, pretty much. Um, I am. I lost my place. So unless I like the company, use its products often, and I have true conviction in the company's growth. I do my own research, follow the news, look for events, catalysts, income statements, earnings, and possibly listen to a conference call here and there if I'm really trying to figure out the future of the company in depth. I don't really use conference calls though. I do my research in companies that I intend to invest in. I follow the 52-week high and 52-week low, what channel the stock is trading in right now, and how long has it been trading in that channel, the candlesticks in the daily moving average. I can't win them all. When I lose, but I don't lose the shirt off my back. Losing $10 to me is like losing $100. I'm broke. I got kids, like I'm sure most all of us do. I used to kick myself when I was down on the money, but you gotta pay. I've learned you gotta pay to play. So, you know, don't beat yourself up if you're playing this game. Just practice and get better at it. So I take the emotion out of it. Meaning, instead of being upset about it, I accept the loss. Only difference is I choose how much I'm going to lose and make a decisive exit before or at my acceptable loss price target. So I'm willing to lose $1. I might get out at say 75 cents.